When people talk about volatility, they often mean fear. But you mentioned it's a quantifiable metric. What is it, and how do we measure it beyond just looking at our dropping account balance?
Fundamentally, volatility is the measure of an asset's price variation over a defined period. If a stock or currency moves quickly and significantly, it's highly volatile. To the analyst, it's a number. And the most famous indicator is the VIX index, which is literally called the fear gauge.
Ah, the VIX.
Yes, the VIX measures the expected volatility of the stock market, specifically the S&P 500, over the next 30 days. When the VIX spikes, it's basically the collective market saying, a storm is coming. Understanding this is the first step. Volatility doesn't just appear. News events catalyze it by rapidly changing expectations about the economic or corporate future.
And your research breaks down these catalysts into what you call the four horsemen of volatility. Let's unpack those. These are the categories of news that we must prepare for.
Absolutely. The first is perhaps the most powerful: monetary policy announcements. This is the muscle of the Federal Reserve or the European Central Bank. If the Fed unexpectedly raises rates, a hawkish stance, it's like applying a handbrake to the entire economy. Credit becomes more expensive, investment slows, and the market generally drops immediately.
A perfect real-world example of that was the Fed's cycle of rate hikes in 2022-2023. That caused extreme volatility across the bond market and the technology sector.
Exactly. The second horseman is geopolitical and macro events. These are the sudden, often unpredictable events: wars, energy crises, trade sanctions, or unexpected election results. They introduce deep uncertainty about supply chains, energy costs, or future fiscal policy.
Think of the US dollar as a ship. A geopolitical crisis is the unexpected iceberg that causes the ship's direction and speed to change violently.
That's where the black swan events usually land.
Correct. The third is key macroeconomic data. The market is constantly adjusting based on reports like inflation data, the CPI, or employment reports like non-farm payrolls and GDP figures. The volatility here isn't just about the number itself, but how much that number differs from economists' expectations.